Good morning, I'm Brian McNee. Today is Thursday. It's August 15th, and here's your morning coffee update. All right, what happened yesterday? Here you go. Brief recap. Mortgage-backed securities, just 5 basis points. Just very little movement. Very well contained within this channel. We expected us to be contained in the channel. The prior day, which was Tuesday, we had PPI. I think we moved 2 basis points net on the day. And yesterday we had CPI. We moved 5 basis points net on the day. Bottom line is, neither inflationary report was hotter than expected to punish pricing, and they certainly weren't weaker, showing a pullback in pricing at all, which would have really helped pricing rally on the mortgage-backed security side. So it's largely as expected, so therefore we didn't really have too much of a reaction. Now let's go ahead and focus on what we got going on today, because I got a lot of data sets today. Retail sales, much stronger than expected. Headline retail sales 3 times stronger than expected at 1%, mark expecting 0.3%. X autos 4 times higher than expected, 0.4%, mark expecting 0.1%. The control group, last time in June it was 0.9, which is ridiculously high, and this time it was up 0.3. That doesn't mean it fell from 0.9 to 0.3, it's just it increased 0.3 on top of 0.9 last time. So overall, a hotter than expected retail sales report. Jobs. Initial weekly jobs claims a little lower than expected, 227, mark expecting 235. Rosy to Riveter, man, just keep getting ugly information from the manufacturing sector. Empire Manufacturing, which is the regional New York Federal Reserve District, fell by -4.7, so it continues to contract. The Philly Fed Regional Manufacturing Survey was down -7, market expecting +7, so a big miss there. Industrial production dropped by -0.6, market expecting -0.3, so twice as worse there. And capacity utilization dropped as well. So across the board, an ugly day for manufacturing data. But the problem is that's not new. That has been the trend for a long time, as we've been in a full-blown 100% manufacturing recession for about a year. Okay, next up, talking Fed, we hear from Harker and Muslim, and then at 10 o'clock we get the National Association of Home Builders, their sentiment index, which isn't a factor in pricing. So how are we reacting to this data? Well, let's take a look at the proprietary intraday line chart. It's about 9:30 Eastern Standard Time. We're down about 20 basis points, which is about right. We should have a negative reaction to a positive economic report like retail sales. So basically, jobs better than expected, retail sales better than expected. Those are both negative for your back-end pricing. What's kind of softening the blow, you might say 20 basis points is not a softened blow, but it could easily be 35, 40 basis points. It's just you had all of this very weak manufacturing data to throw in there to kind of soften it a little bit. I think if you didn't have this manufacturing data at all today as data points, because we had like 3 reports, if those 3 reports didn't hit today, I think we'd be testing our support level, maybe even breaking below it. So the weak manufacturing data helping to offset the strong retail sales data. We also had import prices that came in largely as expected, just a small move upward, not a big deal at all. So there we go. That's what's going on for today. I expect this, again, to stay within this channel. And the beauty of a well-defined channel is you know what your max upside is. If we start moving higher, you know when to pull out. And when it starts going lower towards that support level, you know when you can put money back in. So it's a very well-defined channel, and so you can play it accordingly. I do think by the end of the day, you're still looking at like a -12 to -27 type day for your back-end pricing due to that strength of retail sales. Have a fantastic day and enjoy your cup of joe.